So first up, let me invite Kaustubh Belapurkar of Morningstar Investment Advisors. Hi Kaustubh, good afternoon and thanks very much for joining in. So this investor returns is a very interesting subject because, many times we see that there is not a fair understanding of what an investor's return really is vis-a-vis the returns that the scheme has generated overall. So A, how does an investor know the difference, and B, is it even important to know the difference?
Sure. Hi, Sunara, and thanks for having me on the show. And I think it's a very, very interesting and a very widely accepted concept globally. And let me just quickly talk about what each of these stands for. So typically, we've always been aware of the returns of a fund, right? Which obviously is very widely tracked, gets published, which is what a fund would have, made if you were invested at the start of the period and over a period of time, be it 1, 3, 5, 10 years, whatever the period you're looking at, right? Which is based on the NAV movement of the fund. Now, the investor return is because investors will come in and out of the fund in varying proportions. The investor return is basically what you would call a rupee average return, or what an average investor holding that fund would have made, right? And typically what we've seen, and this is not just an Indian phenomenon, but a global phenomenon, that the investor return will be lower and sometimes dramatically lower than the fund return. So just to give you an example to illustrate this, for instance, suppose the average return of a particular fund is 12% per annum over the last 5 years. The investor return that fund is lower. It could potentially be as low as, say, 9%. That means on an average, investors who've invested in this fund over the last 5 years have only made 9% returns. Because it's important to acknowledge that investors, like I said, come at different points of time, and the experience for one investor to the other will be very different. Unless and until, obviously, you as an investor have been holding that fund for the entire period, for which we are considering the performance, right? Which we know that only happens with a certain segment of investors, does not happen for all. And that's where the challenge, or the gap, as we call it, the behavioral gap, comes in between the fund return and the investor return. And we've seen that it can be pretty outsized at points of time. And I think that's something that investors need to acknowledge and kind of look to address.
So, do some kind of funds tend to have a larger variance in this investor return vis-a-vis the fund returns, or is it, across the board the same?
Yeah, sure. No, that's a very, very important question to talk about. So the first thing is that typically you would see that investor returns will be lower than the fund return. I think that's the proportion of that can vary. And yes, there is data and sort of past track records that show you that if a fund is more volatile, be it the asset class is more volatile or the fund by itself is more volatile, you would tend to have the gap, between the investor return and the fund return tends to be higher. The same thing will typically happen when you're looking at, say, sectoral funds, right? Equity sectoral or thematic funds, where the performance can be quite lumpy. It'll be a lot more volatile. And that's where, again, we've traditionally seen that the investor returns can be quite significantly different from the fund return. Let me give you an example of, from an Indian context. I quickly ran the data for a pharma fund, right? We know that pharma funds received, or, pharma and healthcare funds received a fair bit of inflows from investors over the past few years. Post-COVID, obviously, pharma stocks have run up quite significantly. So when I just look at one of the examples of a pharma fund, over a 3-year basis, that fund returned about 23% as of April 2022. But the average investor return of that fund was 6% lower, right? So an average investor in the fund made 6% less than the fund return. Why has that happened? Because investors tend to look at past performance and try to chase a trend. More often than not, they're quite late to that to that thesis or that story, and then they end up probably selling too early. So that behavioral biases really hurt investors in terms of chasing the recent trends or chasing the most recent good performers, and it can result in a very significant gap between the fund return and the investor return. So there is always an existence of a gap, but the gap can be quite varying depending on the asset class and the type of fund you're investing.
Fair enough. So this behavioral bias that you're alluding to is this recency bias, right? Where you see the latest performance and invest, and that may not necessarily sustain. Are there a class of funds where this can be sort of optimized?
So I would say typically, like I was saying, for fixed income funds, the gap will be a lot lower because the volatility
Yeah,
is
naturally.
lower. For diversified equity funds, it can be reduced, but I think the most important thing is, right, even there, because equity by itself is an asset class is volatile, even if you're in a well-diversified, sector agnostic equity fund, there will still be a reasonable amount of gap that exists. And that also happens because when you look at investor timing of entry and exit into funds, because we've spoken about this in the past, that funds will go through their own cycles of outperformance and underperformance depending on the style and the way they're managing the strategy. But investors don't necessarily always acknowledge that. They will look at the most recent performers that have done well. In fact, we did another interesting study, in fact, 2 studies, and let me just quickly talk about that, which shows some of this data that when we looked at returns by quartiles for funds, what we noticed is that since 2009, quartile 1 funds, so if I just looked at quartile 1 funds on a 1-year basis, 85% of the flows went into Q1 funds on a 1-year basis, which shows that investors are looking at the most recent track record of a fund and trying to invest, which is a challenge. The other thing, which again underpins this strategy, is looking at a study that we did in terms of understanding how many months of performance actually attribute to the entire fund's outperformance over its benchmark. And this is a very narrow set. So just 6 months out of the last 10 years typically account for the entire outperformance of a fund versus its benchmarks. So you as an investor, if you miss those 6 good months of performance, and they can come at any point of time, you would have actually underperformed the benchmark. And that's not actually what you intended to do, right? So that's the challenge. So when investors are trying to chase a trend, move in and out of funds, it can be a huge issue, and especially with equity funds and more so with thematic funds, that can really get blown up with that. Let me share another very recent example. The best performing equity fund, across is returned about 40% over the last 3 years as of April 2022, right? The gap in this fund is about 20%. That means investors on an average made only 20% in this fund. So the behavior gap is almost, high, the equivalent to the investor return, right? So half of the returns were not earned by investors simply because they came too late. When we look to the flows in this fund, 75% of the current assets have come in the last 1 year for that fund. So I think that's the challenge which investors need to acknowledge and address. That you identify funds, stick to your asset allocation, and just stay invested. Don't try to chase trends, for a large part of your portfolio. You want to do that for a little bit of a portion of the portfolio, that's fine, but do not try to time and get in and out of, best performing funds at every point of time, because you could get it wrong both ways.
And you'll also lose the benefit of compounding that you would have accumulated, right? So basically what you're saying then is that the right metric to track is the XIRR, right? Or an investor's personal rate of return. How do they do that?
That's right. Yeah. So essentially you would look at, you can run that in an Excel sort of cash flow, and that's how we actually calculate the investor return also, that, the various periods of time where you've invested and come out of, what has been the value for entry and exit, the cash flows basis, the dates, and you can actually pull out, what your own internal rate of return has been for that period, which will give you a good context as to, how you've been performing as an investor versus obviously the funds that you've chosen. And I think that's the important thing for every investor to think about. And sometimes it's not even, making things too complicated, because, if you just stay invested in the markets, just buy and hold funds, you can achieve a pretty good outcome and narrow the gap between the fund return and your own personal return. So I think that's the underpinning philosophy, that just largely buy and hold. Obviously, if there's something dramatically that's changed with the strategy, you might want to relook and exit, but just chasing more recent performers is always going to be counterproductive for investors.
Absolutely. Thanks, Kaustubh, for joining in and for explaining this. So basically, the next time somebody shows you how well a fund has done, you have to actually sit and think about how well you have done in that fund, because that depends on when you have entered and when you have exited. A quick break. Up next, we'll chat with Sachin Parekh, certified financial planner, to talk about how to analyze the cash portion of equity schemes. Stay tuned.